Financing working capital, trade credit. So in this session, we'll discuss around the premises of key features of working capital financing, which would mean we will determine working capital needs and then discuss over short-term and long-term sources of financing. We will also see what are the important sources of working capital financing, namely trade credit, bank credit, and factoring. In this session, we will particularly see what is trade credit and how it forms an important source of working capital financing. So, key features of working capital financing. A firm decides how its working capital needs are financed only after making sure its working capital needs at the first place. Investment in working capital or current assets, namely investments in raw materials, work in process, finished goods, and receivables, fluctuates over the duration of an year. So even before going there, we have to know that any firm which is a manufacturing firm requires raw materials for producing goods and services. So these raw materials are bought from the supplier, and then the manufacturing firm works on it and produces goods or finished goods. Semi-finished goods will be work in process. So finished goods will be then sold to customers, and then it may be sold on credit or on cash. If it is sold on credits, it will become account receivables for the manufacturing firm. So investment in working capital or current assets, namely investments in raw materials, work in process, finished goods, and receivables, fluctuates over the duration of an year. Hence, sources of working capital are important. Both long-term sources and short-term sources are used to finance the working capital requirement of a firm, and the main sources of working capital financing are trade credit, bank credit, and factoring. So we will in this session see what is trade credit. Trade credit. The credit extended to by the supplier of goods and services to a manufacturing or trading concern is trade credit. Here, cash is not immediately paid for purchases and is deferred over an agreed period of time. So deferral of payment may happen in trade credit. Hence, this deferral of payment shows itself as source of finance for credit purchases for the concern. And in this method, there is no formal or specific negotiation for credit extended. There are also no legal instruments or acknowledgement of debts, and the credit appears in the book of buyers of goods as sundry creditors or accounts payable. Another type of account payable is bills or notes payable. In the case of bills or notes payable, it mandates a documentary evidence for credit purchase to be present, and also a formal obligation to pay for credit purchases before a set maturity date, making it extremely different than the open nature of accounts payable. Hence, it creates a legally enforceable obligation on the part of the buyer of the goods and services to pay on maturity, and also the fact whether to extend trade credit to the buyer of goods depending upon the earnings record of the buyer over a period of time, which is the liquidity position of the firm, etc. In general, trade credit does not involve interest charges. However, there is present an implicit cost of trade credit. Now let us explain how this cost factor plays itself out in the case of trade credit. So here the example given is, this is an example for implicit cost of trade credit. We say trade credit terms is 2/15 net 45, which would mean there is a cash discount of 2% if full payment is done within 15 days. Otherwise, the cost associated is given by the equation discount divided by 1 minus discount into 360 days divided by credit period minus discount period. Hence, as the cost of trade credit is usually very high outside the discount period, buyers are expected to make prompt payment of trade credit within the discount period and should avail the permissible discount as per the terms of the trade credit. If buyers are not able to make the payment during the discount period, they may postpone payment on this item till the last day of the net credit period, within which they should make prompt payment so that the creditworthiness is not affected by such a transaction. So this completes financing working capital trade credit. Thank you.